You wake up on a Tuesday morning in a home that you either own or rent. Flip a switch that illuminates a room using electricity generated somewhere far away and transmitted across a lattice of aging infrastructure. Then you step into a shower where water that has been treated, pumped, and pressurized emerges from a faucet at a temperature you find acceptable. And you do all of this before you have exchanged a single dollar of currency with another human being for the day. Yet, in that quiet sequence of pre-dawn actions, you have already participated in a dense, layered, and almost entirely invisible cascade of taxation that will never appear on a single bill or receipt with the word tax written anywhere upon it. Later that morning, you will earn a paycheck and observe with a familiar wince the explicit deductions for federal income, state income, Social Security, and Medicare. And because those line items are so visible and so painful, the human mind will naturally conclude that this is the entirety of the tax burden that has been levied upon your productive labor. You will file a return each spring. You will calculate a refund or a balance due, and you will close the book on the matter, satisfied that you have accounted for your contribution to the public purse. But this belief, while understandable and nearly universal, is a profound misunderstanding of how the modern fiscal state actually extracts resources from the economic ecosystem, because the explicit taxes on your income are merely the outermost, most visible doll in a nested set of taxation layers that extend deep into the foundation of every transaction, every price, and every asset you will ever encounter. This structure is what we might call the Matryoshka tax system, named for the Russian nesting dolls that conceal smaller and smaller versions of themselves within each hollow shell. And once you learn to see these hidden layers, your entire perception of what it means to be a participant in a modern economy undergoes a quiet but irreversible transformation. The outermost doll, the one we all recognize and resent with varying degrees of intensity, is the direct and explicit taxation on income and payroll, a layer that is designed to be highly visible and to create the psychological sensation of having fully discharged one's civic duty. Federal income tax brackets, state withholding schedules, and the flat percentages assigned to FICA contributions are all clearly itemized and, for the vast majority of wage earners, automatically removed before the funds ever reach a personal bank account. The visibility of this layer serves a specific and important psychological function within the broader fiscal architecture. It provides a focal point for the natural human frustration with paying taxes, a kind of pressure release valve that allows citizens to believe they have identified the full scope of the problem and can now move on with their lives. Politicians debate the precise calibration of these brackets endlessly, and entire industries of tax preparation and financial planning have been constructed around the optimization of this single, visible doll. But the moment you accept a paycheck and look at the net deposit figure, you are not looking at the money you get to keep before engaging with the rest of the economy. You are looking at the starting capital you will now deploy into a dense thicket of embedded, indirect, and cascading taxation that will silently claim an additional and surprisingly large portion of every subsequent dollar you spend or save. The second doll, nested just inside the first and far less visible to the naked eye, is the layer of embedded taxation that resides within the price of every good and service you purchase. When you buy a loaf of bread for $4, you are not simply exchanging currency for flour, yeast, and the labor of a baker. You are also paying, in fractional increments that are impossible to isolate on the receipt, a portion of the corporate income taxes paid by the agricultural conglomerate that grew the wheat, the fuel taxes paid by the trucking company that transported the grain to the mill, the property taxes paid by the commercial bakery on its industrial space, the payroll taxes paid on behalf of every worker who touched the supply chain, and the various licensing fees and regulatory compliance costs that function as de facto taxes on economic activity. Each of these entities along the chain of production is not a charity. They are economic actors who must preserve a margin of profitability to continue operating, and every tax imposed upon their operations is therefore incorporated into the final price that the consumer must bear. This is not a matter of corporate greed or political ideology. It is simply the mechanical reality of how prices are formed in a system where the state extracts a percentage of value at multiple discrete points in the production process. The baker does not eat the cost of the property tax on their building out of personal benevolence. That cost is baked into the price of the bread, and you, the end consumer, are the one who ultimately pays it, even though the transaction appears to be a simple private exchange between you and the baker. The cumulative effect of this embedded layer is that a substantial portion of every dollar you spend is actually a silent, invisible tax payment, routed through private intermediaries. A payment that you make without ever signing a check to the Treasury or seeing a line item on a government form. The third doll in the nested set, and one that is even more deeply concealed from casual observation, is the layer of inflation taxation, which operates not as a direct levy on a transaction, but as a slow, steady erosion of the purchasing power of every currency unit you hold over time. Inflation is often discussed in the public discourse as a kind of natural economic weather pattern, an unfortunate but unavoidable side effect of a growing economy that central bankers attempt to manage with the crude tools of interest rate adjustments and open market operations. But when viewed through the lens of the Matryoshka tax system, inflation reveals itself to be something quite different. It is a deliberate, policy-driven transfer of value from the holders of currency and fixed income assets to the issuers of that currency, namely the sovereign government and its central banking apparatus. When the money supply expands faster than the productive capacity of the economy, either through explicit deficit spending financed by bond issuance or through the more arcane mechanisms of quantitative easing, the value of each existing dollar declines relative to the goods and services it can command. This decline functions as a tax on savings, a tax that is never voted upon by any legislature, never itemized on any pay stub, and never acknowledged in any public filing, but one that nonetheless extracts real resources from anyone who holds cash or bonds while simultaneously reducing the real burden of the government's own outstanding debt obligations. The saver who diligently accumulates a cash reserve over a decade and watches its purchasing power decline by 20 or 30% has, in a very real and measurable sense, paid a tax to the issuing authority that devalued the currency, and this tax is collected in absolute silence, without a single piece of paper being mailed to their home. The psychological genius of the inflation tax is that most people do not perceive it as a tax at all. They perceive it as prices going up, as if the goods themselves have become more valuable, when in fact the measuring stick has simply been shortened. Beneath even the inflation layer lies a fourth doll, one that is so deeply embedded in the legal and regulatory architecture of the economy that it is rarely recognized as a form of taxation at all. And this is the layer of compliance costs and regulatory friction. Every hour that a small business owner spends filling out forms, navigating licensing requirements, and ensuring adherence to an ever-expanding corpus of administrative rules is an hour that cannot be spent on productive value-generating activity, and the economic burden of those lost hours is ultimately passed through to the consumer in the form of higher prices or reduced service quality. This burden is functionally indistinguishable from a tax in that it transfers resources from private actors to a public objective, but it does so indirectly by consuming time and attention rather than by transferring currency. The distinction is largely semantic because the economic outcome is identical. A portion of the economy's productive capacity is diverted toward an activity that generates no direct value for the consumer, but is mandated by the state. When you pay a higher price for a service because the provider must employ a dedicated compliance officer, maintain specialized record-keeping systems, or navigate a complex permitting process that adds months of delay to a project, you are paying a tax, one that is collected not by the IRS but by the diffuse and largely invisible machinery of the administrative state. This layer is the most opaque of all because it is never quantified on any government budget. It is simply absorbed into the cost structure of the economy and passed along to you in increments too small and too widely distributed to be traced back to their source. The fifth and final doll, the one nestled at the very core of the Matryoshka system, is perhaps the most profound and the least acknowledged of all. The implicit tax imposed by the monetary system on anyone who lacks access to the mechanisms of financial leverage and asset ownership that allow the wealthy to partially offset the erosive effects of the outer layers. The entire structure of the tax code, from the preferential treatment of long-term capital gains to the mortgage interest deduction to the stepped-up basis rule at death, is calibrated to provide relative shelter to those who derive their income from the ownership of appreciating assets rather than from the sale of their own labor. The wage earner who receives a W-2 at the end of the year faces the full, unmediated force of every layer of the Matryoshka system. Their income is taxed directly and visibly. Their consumption is taxed indirectly and invisibly. Their savings are taxed through inflation, and their time is taxed through compliance costs. The asset owner, by contrast, can defer the realization of gains indefinitely, borrow against appreciated assets without triggering a taxable event, and pass wealth to the next generation with a cost basis that effectively erases decades of accumulated tax liability. This differential treatment is not an accident or an oversight. It is a deliberate feature of a system that was designed over many decades and through countless incremental adjustments to encourage the formation of capital while extracting the bulk of public revenue from the flow of labor income. The core of the Matryoshka system, then, is a quiet but relentless transfer of the fiscal burden from those who own assets to those who work for wages. And this transfer is accomplished so subtly and through so many nested layers of indirection that the average participant in the economy never perceives the full shape of the structure in which they are enclosed. When we step back and perform the systemic zoom-out, we begin to see the Matryoshka tax system not as a collection of isolated and unfortunate fiscal realities, but as a coherent, integrated architecture for extracting resources from a population while maintaining the appearance of a far lower and more transparent tax burden than actually exists. The visibility of the income tax serves as a kind of cognitive decoy, drawing the attention and the ire of the taxpayer toward a single, manageable target while the deeper layers operate in the shadows, quietly and continuously siphoning value from every corner of economic life. The total effective tax rate paid by a median wage earner in a developed economy, when all of these nested dolls are accounted for and aggregated, is not the 15 or 20 or 25% that appears on their annual filing. It is a figure that approaches and in some cases exceeds 50% of their total economic output. Once the embedded consumption taxes, the inflation erosion, the compliance friction, and the structural advantages conferred to capital are fully accounted for. This figure is not a conspiracy theory or a political talking point. It is the mathematical consequence of a system that has evolved over more than a century to maximize the extraction of resources while minimizing the political friction associated with that extraction. The genius of the Matryoshka design is that no single layer feels unbearable on its own. The income tax is grudgingly accepted as the price of civilization. The embedded taxes in prices are too diffuse to be felt individually. Inflation is blamed on mysterious global forces. Compliance costs are invisible to the end consumer. And the preferential treatment of capital is dismissed as a technical detail of the tax code that only accountants need to understand. Only when the dolls are unnested and laid side by side on the table does the full, imposing scale of the structure become apparent. Given this understanding of the hidden layers that surround and permeate every economic decision, the identity shift required to navigate the Matryoshka tax system is not one of anger or resentment, because the system is not a malevolent conspiracy, but rather an emergent property of a century of political and economic evolution that no single actor designed or controls. The identity shift is one of clear-eyed, unsentimental awareness, a willingness to see the structure for what it is and to make deliberate, strategic choices that acknowledge the reality of the nested dolls rather than pretending they do not exist. This shift begins with the recognition that your after-tax income is not the end of the story, but merely the starting capital for a journey through a landscape that is, by design, tilted to extract a portion of your resources at every turn. It continues with an understanding that the only reliable, long-term counterweight to the erosive forces of the Matryoshka system is the ownership of productive, appreciating assets that can generate returns that outpace the combined extraction rate of the nested layers. A savings account, no matter how diligently funded, is a leaky bucket in a system that is structurally tilted against the saver. It is the financial equivalent of trying to fill a bathtub while 5 different drains are open beneath the surface of the water. The ownership of assets, whether equity in businesses, income-producing real estate, or the specialized skills and relationships that constitute your personal human capital, provides a vessel that is, if not fully sealed against the leaks, at least far more buoyant than the alternative. This is not a call to speculation or to the abandonment of prudent cash reserves. The liquidity and optionality provided by cash remain essential components of a resilient financial life, as discussed at length in our examination of the solvency paradox. Rather, it is a call to a more sophisticated and less naive understanding of the economic environment in which you are operating. When you understand the Matryoshka tax system, you stop viewing tax optimization as a slightly distasteful activity reserved for the wealthy and begin viewing it as a necessary and rational response to a landscape that is already optimizing against you. You become more intentional about the structures you use to hold assets, the timing of your income realization, and the allocation of your resources between consumption, saving, and investment. You recognize that every dollar you spend on a taxable good or service carries within it the invisible weight of all the nested dolls that preceded it, and you make your consumption choices accordingly, not out of ascetic self-denial, but out of a calm, informed awareness of the true cost of each transaction. And perhaps most importantly, you release yourself from the guilt and confusion that arise from feeling that you are somehow failing at a game whose rules you never fully understood. The game was never designed to be transparent, and the score was never being kept in the currency you thought it was. The Matryoshka tax system will continue to operate, quietly and relentlessly, long after you finish watching this video and return to the routines of your day, but you will return with a new lens through which to view those routines, and that lens, once acquired, cannot be unacquired. You will see the dolls nested within dolls in every price tag, every paycheck, and every policy announcement. And while this awareness may not change the amount of tax you pay in the immediate term, it will change profoundly and permanently your understanding of what it means to earn, spend, and keep. A dollar in a world where the measuring stick is always silently being shortened.